Your balance has barely moved in 3 years. You're still contributing, and you've started to wonder what for. That feeling has a name nobody uses, and a history almost nobody tells. From February 1966 to August 1982, the Dow Jones Industrial Average finished almost exactly where it started, 16.5 years of nothing. Over the next quarter hour, we'll walk those years in 6 chapters, what they actually felt like, what dividends and steady buying were quietly doing underneath the flat line, the honest cases where waiting never paid, and how it finally ended, in the worst month anyone could remember. Before we begin, picture a kitchen table in the autumn of 1982. A man is reading the stock tables in the back of the newspaper, small gray type, 6 columns across. And his eye stops on the Dow Jones average, a little over 1,000. He remembers that number. He was a young man in February of 1966 when the Dow first came within 5 points of 1,000, and the papers called it a milestone. 16 years have passed. He has raised children. He has nearly paid off a house, and the number is the same. So this is the question. Not what you do when the market frightens you for a month, what you do when it stops rewarding you for most of your working life. Chapter 1. The number that would not move.
A crash is loud, brief, and legible. It hands you a date, a story, a villain. It also hands you sympathy. Everyone you know is watching the same thing, and your fear is socially permitted. A long plateau gives you none of that. There's no headline, no explanation to offer your spouse, no moment at which your suffering is officially acknowledged. There's just the statement arriving each quarter, looking like the last one. The arithmetic of the era is stranger than most people remember, so let's speak it plainly. On the 9th of February, 1966, the Dow closed at 995.15, the first time it had come within a whisper of 1,000, and the newspapers treated it as an arrival. Then it failed at that level, again and again. It didn't manage a close above 1,000 until the 14th of November, 1972, at 1,003. It peaked just over 1,050 on the 11th of January, 1973, and then fell 45%, bottoming at 577 on the 6th of December, 1974. It was still under 1,000 in the summer of 1982. Notice the shape of that. There's a severe bear market sitting in the middle of this story, and 1973 and 1974 were brutal. The bear market is the part everyone remembers.
The years on either side of it are the part that did the damage. An investor standing in 1969 or in 1977 couldn't point to a disaster. They could only point to a number that refused to move and to a decade of their own life spent watching it. That's the part worth carrying. Falling markets frighten people out. Flat markets bore them out, which is quieter and, over 16 years, more effective. So the first thing to let go of is the idea that a moving line is the evidence you're doing something right. The market doesn't owe you a return in the particular year you happen to be watching it, and the absence of drama is not the absence of progress, which is a comfortable place to stop, so let's not stop there. Because flat is the flattering version of what happened. While the headline number stood still, something else was moving underneath it, and it was moving against you. Chapter 2. The erosion nobody announced. Consumer prices roughly tripled across those years. On the standard 1982 to 84 base, the U.S. Consumer Price Index averaged 32.4 in 1966 and 96.5 in 1982. That is a little over 7% a year, sustained for 16 years, with violent spikes along the way. Annual inflation ran above 11% in 1974.
Above 11% again in 1979. It peaked at 13.5% in 1980. Interest rates followed it up. The prime lending rate reached 21.5% in December of 1980. The federal funds rate averaged roughly 19% in the middle of 1981. If you were alive and holding a mortgage application, those numbers were not abstractions. Now put the two facts side by side. A stock average that went nowhere in dollars, and dollars that lost around 2/3 of their purchasing power. That is the real experience of the period, and it's considerably harsher than the word flat suggests. Dividends helped enormously in nominal terms. We'll get to exactly how, but they did not turn this window into a win. The conclusion from the long-run return studies is that American stocks delivered something close to zero real total return across this stretch. Let me say the uncomfortable version straight, because a lesson that only works when the history flatters us isn't a lesson. A patient investor who put a lump sum in during early 1966 and touched nothing for 16 years was not rewarded inside that window. They were rewarded afterwards, and only because they were still there. Hold both things at once without letting either collapse the other. Markets have compounded over long arcs. And there exist 16-year stretches in which a lump sum investor gained nothing in real terms. Anyone who offers you only the first half of that sentence is selling you something. So here's the thread we pick up next. If a person who invested at the 1966 high genuinely gained nothing for 16 years, what exactly was being built during all that time? Because something was. The next 17 years didn't come from nowhere. Chapter 3. The work being done underground. 2 engines ran continuously through that whole flat stretch, and neither of them appears on a price chart. Reinvested dividends, and new money buying shares that were getting steadily cheaper against the earnings behind them. 2 anchors will show you this. First, the yield. The S&P 500's dividend yield began the era around 3% in early 1966 and drifted upward through the 70s as prices stalled while payouts kept rising, reaching roughly 6% by 1982. Second, valuation. Robert Shiller's cyclically adjusted price-to-earnings ratio stood around 24 in February of 1966 and had fallen to about 6.6 by the summer of 1982, one of the lowest readings anywhere in that series. Read those together and you can see what was actually happening. Prices weren't moving. But the ownership sitting behind each dollar was getting larger every year. Here's the arithmetic, and please take it as arithmetic and not as a promise. As an illustration, imagine $10,000, a 6% yield, dividends reinvested, and prices perfectly unnaturally flat. The rule of 72 tells you the share count doubles in about 12 years. $20,000 worth of the same business at the same price per share on a chart that never rose. You'd own twice the company, having done nothing except decline to interfere. No such clean scenario exists in the wild. Real yields wandered, real prices lurched, and I'm not forecasting anything. But it explains the structural fact underneath the era. Roughly half the modest nominal return of 1966 to 1982 came from the part nobody was watching, and the shares bought in the cheapest years, 1974, 1979, 1982, did the heavy lifting for the 17 years that followed. Now think about the person who simply contributed a fixed amount every month from 1966 onward. Their average purchase price ended up far below the 1966 peak, for the plain reason that the market spent most of the next 16 years below it. The flat decade was doing their work for them, month after month, at prices they would never have chosen. Which changes what those sideways years actually were. A market that doesn't rise is where an ordinary saver buys ownership cheaply. That is the whole of it. Set the contribution to happen automatically and let those years do the thing they're for. Which raises the obvious question. If that was true, and it was demonstrably true, why did so few people manage to sit through it? Chapter 4. The year nobody wanted to own anything. On the 13th of August, 1979, Businessweek ran a cover story titled "The Death of Equities." It argued that inflation had permanently broken the stock market and that a generation of savers had rationally moved on. I want to be careful here because it's easy to laugh at that cover from where we sit. It was not a stupid article. By 1979, the evidence had been piling up for 13 years. Every fact in it was checkable. It was published roughly 3 years before the start of one of the longest bull markets in recorded history. That same year, in the March 1979 issue of Econometrica, Daniel Kahneman and Amos Tversky published Prospect Theory, the paper that gave loss aversion its formal shape, showing that the pain of a loss lands about twice as hard as the pleasure of an equal gain.
The mood and the explanation for the mood arrived within the same 12 months. And a third detail from those years. On the 31st of August, 1976, John Bogle launched the first retail index fund. The offering targeted $150 million. It raised $11.3 million. Nobody wanted it. Meanwhile, the entire machinery of patient investing was being quietly assembled in exactly those years. Vanguard founded in 1974. The individual retirement account created by ERISA in September of 1974. The 401k provision written into the Revenue Act of 1978. All of it built while owning stocks looked like a discredited idea. As for what stepping away costs, J.P. Morgan Asset Management's Guide to Retirement examined the 20 years ending in December of 2022 and found that $10,000 left fully invested in the S&P 500 grew to about $64,844. Miss only the 10 best days, and you finish with roughly $29,708. Do that subtraction with me. $35,000 of difference, out of 65. More than half the result gone. 20 years is about 5,000 trading days, so those 10 days are 0.2% of the period.
And 7 of the 10 best days occurred within 2 weeks of the 10 worst days. The good days don't send an invitation. They turn up in the middle of the bad ones, which is precisely when you're least inclined to be present. So treat your own certainty as information about your emotional state rather than about the market. When selling stops feeling frightening and starts feeling obvious, sober, reasoned, overdue, the mature conclusion of a thoughtful person, that specific feeling is the one to distrust. Except, there's an honest objection sitting in the room, and if I skip past it, you'd be right not to trust anything else I've said. Wait long enough and it comes back is a claim history does not always honor. Chapter 5. When the waiting doesn't end. 3 real counterexamples, stated without hedging. First, Japan. The Nikkei 225 closed at 38,915 on the 29th of December 1989 and did not close above that level again until the 22nd of February 2024. 34 years. An investor who started at that peak aged 40 was in their 70s before the index recovered its nominal high. That is longer than most people's entire investing life. Second, the American lost decade. The S&P 500's total return for the calendar decade of 2000 through 2009 was slightly negative, roughly -1% a year, about -9% cumulative. The worst calendar decade in the index's modern history, and it happened within living memory. Third, individual companies do not mean revert. General Electric was removed from the Dow Jones Industrial Average in 2018 after more than a century as a component, the last of the original members to go. Citigroup's share price, adjusted for its 1-for-10 reverse split in 2011, peaked at roughly $550 in 2006 and has never gone near it since. It always comes back is true of diversified indices over long spans and simply false of individual businesses. So what actually protects you? 4 things, all of them boring, none of them a matter of attitude. Global diversification. At the 1989 peak, Japan represented something on the order of 40% of world equity market value. An investor who owned the whole world rather than one country lived through those 34 years with an entirely different outcome because the rest of the world went on compounding. Breadth. A broad index quietly replaces its own failures. General Elect left the Dow, and the Dow carried on, which is a form of protection no single holding can give you. Ongoing contributions. The person who kept buying through Japan's long flat stretch or through America's lost decade never paid the peak price on most of their shares. And the fourth, which is the most underrated, sequence of returns planning. William Bengen's 1994 study in the Journal of Financial Planning, the paper behind the familiar 4% guideline, arrived at that figure precisely because the worst starting years for a retiree in the historical record were the mid to late 1960s, the exact years we've been describing. Sit with the 2 people that implies. February 1966, one is beginning to save, one is beginning to retire. Identical market, opposite lives. The saver was handed 16 years of cheap shares and didn't know it. The retiree was selling assets into a real decline of 2/3 and needed enough in cash and bonds to draw from so that the market never got to choose the moment for them. Patience takes 2 different shapes depending on whether you are adding money or drawing it out. Which leaves the last thing. If nobody can see the turn coming, what did the end of 16 barren years actually look like from inside? Chapter 6. The Quietest Beginning. Paul Volcker became chairman of the Federal Reserve on the 6th of August 1979 and did the unpopular thing. He raised rates until inflation broke and accepted the recession that arrived with it. Annual inflation fell from 13.5% in 1980 to 3.2% by 1983. The cost was severe. U.S. unemployment reached 10.8% in November and December of 1982, the highest since before the Second World War. And that is the month in question.
The bull market is conventionally dated from a Dow close of 776 on the 12th of August 1982, with a cyclically adjusted price-to-earnings ratio near 6.6 and the dividend yield near 6%. So the beginning of one of the great compounding stretches in market history coincided almost exactly with the worst unemployment in living memory and a set of newspaper headlines that would have persuaded any reasonable person to sell. Nobody rang a bell. Nobody standing at that kitchen table knew what they were standing in. What followed is the part everyone remembers, and it's the part I'm deliberately not asking you to expect.
The Dow closed above 10,000 for the first time on the 29th of March, 1999, at just over 10,000, something close to 13 times the August 1982 level on price alone in under 17 years. That's offered as history, not as a template. There is no rule saying a long drought must be followed by a great harvest, and Japan is the standing proof. What the record does say is narrower and more useful to you. The returns of 1982 to 1999 were only ever available to people who were already invested in 1982. And the only people invested in 1982 were the ones who had spent the previous 16 years being wrong, bored, and gently mocked for it. The reward arrived afterwards, and it went to whoever was still holding. So give up the idea of stepping out and returning at the right moment. That skill has never existed. Build a plan you can hold while it's producing nothing, because that's the condition it will most often be in. You will probably live through one of these, not 16 years necessarily, but some long stretch where the balance doesn't move, where the money goes in and nothing comes back, where the sensible people around you conclude that this particular idea has had its run. It won't feel like a test, because tests announce themselves.
It'll just feel like the weather. And the strange, quiet fact underneath 1966 to 1982 is that nothing was actually wrong during those years. The dividends kept arriving, the companies kept earning, the shares kept getting cheaper against what they owned. The only broken thing was the number in the newspaper, and the number in the newspaper was the one thing that could never do anything for anybody. So we've walked the 6 chapters I promised you. What those years felt like from inside when there was no disaster to point at. What inflation was doing to a flat line that the flat line never showed. What dividends and steady buying were doing underground, out of sight. The honest cases, Japan, the lost decade, where waiting didn't pay, and the 4 structural things that protect you from them. And how it ended, in the month with the worst unemployment in 40 years, with nobody watching. Which brings us back to your balance, and to 3 years of very little. I hope it looks slightly different now. Not because the flatness isn't real. It's real, and I won't pretend it's pleasant, but because you can see what it is. Not a verdict on your plan, the condition your plan was designed for. When your own long stretch comes, the useful question is smaller than how long it lasts.
Nobody knows that, and anyone who says otherwise is guessing in a confident voice. Is the money still going in? Is it spread widely enough that no single country or company gets to decide your outcome? And can you leave it alone? That's the entire job. It isn't impressive, and it doesn't photograph well. It's just the thing that has worked. If this was worth your time, you're welcome to subscribe. This is a slow channel, and it tends to reward the patient. And I genuinely like to know which part stayed with you. The buying that was happening underground, or the honest case where the waiting didn't pay. Leave it in the comments if you feel like it. Thank you for spending this time here.